Hello and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. My name is Michael Hewson and once again joining me is Pepperstone Senior Market Strategist Michael Brown. Hello Michael, fresh from Madame Lagarde's ECB press conference.
Yes, very good afternoon to you, mate, from a horrible grey and wet city of London today. And just what we needed to perk us all up was the orange one in Frankfurt delivering an hour-long diatribe. That's what we're all after as the week draws to a close.
Yeah, I think it was quite an interesting press conference, and we'll go into it in more detail, I think, after we've done the risk warning. But obviously, another 25 basis point rate cut, now 12 months. DAX has hit record highs as a result of that again. By contrast, Bank of Canada this week left rates unchanged. So I think we're getting to that point whereby there's a case for a pause and maybe there's less of a case for a cut. Having said that, I think the risks now could go either way. Putting that to one side, before we get into that, I think markets have pretty much shrugged off the 50% tariffs. I think we're in a bit of a no man's land, I think, if you like, trading below record highs. Bit of a holding pattern, would you say?
Yes, it has been a relatively sluggish start to the month of June, I would say. Now, that's not for want of fresh catalysts. As you say, we had that doubling in steel and aluminium tariffs. We've had a sort of run of softish data out of the United States, and I'm very nervous as I speak because I believe that as we're recording this, President Trump and President Xi may have just held a phone call or maybe on the phone. There are various sort of conflicting reports around that. Yeah, I think, as you say, sort of no man's land, conviction somewhat lacking amid ongoing trade uncertainty, of course, but also as we move rapidly towards the May jobs report tomorrow lunchtime.
I would say cautious optimism, perhaps,
Yes,
because we are trading just below the highs that we've seen earlier this year. Anyway, we'll talk about all of that as well as looking at this week's numbers from the likes of Chemring, B&M European Retail, BAT, Fevertree, Wise, Dr. Martens and Wizz Air. Before looking ahead to next week's UK data, the spending review, must admit I'm incredibly cynical about that because it's probably just another PR exercise on the part of our government, as well as the first quarter numbers from Tesco's and the Apple Worldwide Developers Conference. Before we get into all of that, it's risk warning time. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. Retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, ECB, 8 rate cuts in 12 months. Inflation now at 1.9%, falling from 2.2% the previous month, and core at 2.3%. It wasn't totally unanimous, was it? And I think Lagarde's comment was actually quite interesting. I don't think there's any surprises for guessing who dissented.
No, you're absolutely right. What was the exact language she used? That the decision was almost unanimous.
Almost unanimous. Well, it's either not or it isn't.
It is or it isn't.
Yeah.
So that means
it's
it wasn't.
Like being almost pregnant.
Well, congratulations to you, man. It would have been the Austrian representative, Robert Holtzmann, who dissented in favour of holding rates steady. And he'd actually flagged in an interview beforehand that he thought there was no need for a cut in June or July. So that wasn't particularly surprising. I think my sort of overall take from the ECB is that in an ideal world, if everything goes their way, they probably don't want to have to cut anymore. I think Lagarde went to great lengths at the press conference to stress how policy is in a good place given the current environment. And when she's saying that, having just unveiled a round of economic forecasts that downgraded the inflation profile next year to 1.6% and downgraded 2027 2%, you would expect that those forecasts elicit a more dovish response from the central bank. But the fact that didn't happen suggests to me that they don't really want to deliver any more rate cuts, and they're only going to do so if some sort of external factor, probably in the realm of trade tensions, ends up sort of forcing their hand on that.
I'm actually surprised they did cut rates, given the fact they downgraded their inflation forecasts and the fact that inflation is now at their target rate. That would suggest that if you work on the basis that rate cuts are a lagging indicator, that there work has already been done, and ultimately this rate cut is more symbolic than anything else.
Yeah, I'm not surprised they delivered a rate. I can completely see the case for having held steady from a data point of view. I think the problem is, given that all of the language, all of the guidance have been towards a rate cut, markets have fully priced in a rate cut. If they then didn't deliver it, you end up tightening financial conditions to a degree that they simply would not want to see at this moment in time. Yeah, you could argue it's more symbolic in nature, but I think they probably backed themselves into a corner and had no choice but to deliver it, which frankly is probably why we had the hawkish rhetoric to come along with the 25 basis point cut. So you sort of even it out a little bit.
Yeah, I mean, the euro's modestly higher. It's just below 115, slightly outperforming the pound, slightly higher against, yes, pretty much slightly higher across the board. There was a question, I think, in the press conference about the fact that can the ECB afford a stronger euro? Or can the economy afford a stronger euro? We've been higher than current levels, so I think they're probably okay.
Yes, I would say they probably are. Although I would, and I'm just trying to get this in front of me because I've deleted this off my screen before we started speaking. I believe where the euro is currently trading now, which as you said is about 115. That is still quite a way above the exchange rates that the ECB put into their forecast. I think they were about 108 this year. 111 this year, 113 next year were their assumptions for the inflation forecasts. So just worth bearing in mind that we are still a little bit above where the ECB have sort of modelled things.
But they've changed those assumptions, haven't they? Because I recall a
They have, because they
conversation
were
with
at
you that had
104
them
in
at
the March
104.
forecast. Yeah, it was 104 last time out,
Yeah.
so quite a substantial bump higher. But yeah, I mean, fundamentally, we can talk about exchange rates, we can talk about inflation, we can talk about growth. What the ECB do next, I think, fundamentally depends on what Trump does next, as there's so much of markets and macro at the moment.
Well, I would actually beg to differ with that. I would argue that
go
it
on.
really depends on what the EU does, because
Well,
ultimately
yeah.
the EU can choose whether to retaliate or not. And that will ultimately determine whether or not inflation makes a comeback or doesn't make a comeback, because ultimately Trump's tariffs only really damage the US consumer. Obviously, they damage companies that export to the US. But, you know, the net victim of any tariffs is basically the incumbents of the country that imposes them.
No, that is a very fair point, actually. That is a very fair point. But of course, on the note of tariffs, we had the doubling of steel and aluminium levies, as we mentioned earlier on, which came into effect on Wednesday. But, you know, looking at markets, you wouldn't even know it had happened.
No, I think UK's been exempted from them temporarily until July the 9th, I think, on the basis that they need to finalise the restructuring of British Steel out of the hands of their Chinese owners. So obviously those details need ironing out, and potentially they're still 25%. They're not 50.
Yeah.
Is there a chance they could be reduced to zero? I certainly think the government hopes that it will be the case.
Yeah, the government do seem to hope that it is going to be reduced to zero. But then if you think back to the trade deal, I use inverted quotes because it hasn't actually been written down anywhere, that's been struck between the UK and the US, there's still that 10% baseline tariff in place. So you sort of go, well, if there's a 10% tariff on everything, I'm not entirely sure that the Trump administration would be happy to just slash steel to zero. Certainly one to watch, but yeah, I wouldn't be as optimistic as those on Whitehall on that front, I don't think.
Well, we've got another month or so to find out whether or not that will
Well,
happen. So
yeah, we were meant to get 90 deals in 90 days. We've had one in 60 days so far, so there's quite a lot of work to do.
Oh well, there's a film in that. It's not exactly around the world in 80 days, but yeah, 90 deals in 90 days.
Close enough.
Yeah, I suppose. Okay, so let's look at this week's economic data out of the UK. Segue in. Obviously, we've had mortgage approvals, consumer credit. What did they tell us, Michael, about consumer per se ahead of next week's GDP, wages, and unemployment numbers?
Yeah, well, I mean, the first thing to say is that the GDP and employment data that we get next week is for April, whereas, so, you know, it is slightly delayed compared to some of the other indicators that we get. To be completely honest, I'm not entirely sure that the data this week really told us particularly much. Yeah, we saw a drop off. I think it was the second or third month in a row that we've dropped off in terms of mortgage approvals, but is this just a delayed impact of the stamp duty changes coming in? I think the data is still quite skewed by all the various taxation changes that we've had. Also, and again, I don't want to be clutching at straws too much with this one, but we did have Easter during the month of April as well. So naturally, you've got 2 bank holidays, half term in terms of schools as well. That's probably going to slow activity in the housing market a little bit as well. But yeah, I'm
PMIs?
not. Sorry?
PMIs?
Yeah, well, we saw a bit of an upward revision there, didn't we? On the services number, which
Yeah.
was promising and
Easter?
pleasing. I'm not going to blame that one on Easter because
Why
that's
not?
May data.
Well, you got more. Well, I suppose, yeah. All right, go on then.
You see, what I would say with that one though is, and I think we're going to see this
Got
quite a
2 bank
lot.
holidays though.
We did. I think the big upward revision, though, in the PMIs,
Mm.
at least the services number, was just purely due to when the survey is done. Basically, the preliminary survey had a much the bulk of the period would have been around the time just before, just after the US-China trade truce came in. The final survey would encompass everything that's happened since then. So naturally, I think anyone who responds to the final number or the final survey is going to be more optimistic than people responding to the preliminary number. So I think that's just should we say, a quirk in how the numbers are calculated.
Yeah, I mean, we did have fairly decent weather in May as well, which probably will have helped, I think, on the margins when it comes to hospitality and retail, perhaps. Maybe there's a residual effect of the pull forward that we saw in March and April. Who knows? I mean, again, I'm clutching at straws here. Looking at the UK economy, I think we both understand or are surprised at the fact that it appears to have performed an awful lot better than we thought it would.
Yeah.
When we were sitting here, say 3 or 4 months ago. So hope is that will continue, but obviously I have my concerns about that. We'll probably get a better flavour for it with the housing market. I think with next week's numbers from the likes of Crest Nicholson and Bellway Homes, they were fairly optimistic leading into March. So it'll be interesting to see whether those numbers or that optimism is reflected in their numbers. As far as earnings this week are concerned, bit of a mixed bag, all told. Shall we start with Chemring?
Why not?
Seen a really big jump this week in Chemring shares, up 4% today and up quite sharply in the last 3 days, reversed that little bit of a decline that we saw last month on the back of concerns about, I think, a write-down or something. But they've reported in the first half a 5% increase in revenue to £234 million. I mean, that's the first half. That gives you an indication of how much of a niche defence contractor it is when you consider that £234 million is its first half revenue.
Yeah, compared to some of the competitors in that sector, that's small fry, really, isn't it?
It's small beer, isn't it?
Yeah.
But its order book saw a sharp rise of 488 million in the first half to a record 1.3 billion pounds. That's an increase of 25% from a year ago. Key growth area was bombs and bullets. What a surprise. And of course, obviously, we've got strategic defence reviews in both the UK and the US, not the UK and the US, the UK and Europe. So that could well turbocharge its growth potential, and it's certainly been reflected in the share price. And interestingly, there's been no follow-up on that Bain bid, has there?
No, it has all gone a little bit quiet on that front, which is certainly something to keep a close eye on. As you say, they are perhaps one of the more niche, smaller players in the overall defence theme, but their results very much speak to what we're seeing more broadly, which is a huge uplift in defence spending across the globe. And I think that 42% year-on-year increase in the order book is really, well, clearly very strong, but also speaks to that global trend. And another thing that I saw this week, just in terms of defence more broadly, obviously we've just gone through the quarterly rebalancing of a whole load of equity indices. The Stocks 50, which is the blue chip index across the channel, they have they have taken out Kering, the luxury goods conglomerate, and they're replacing them with Rheinmetall, the German defence giant, which I think just speaks volumes about the way that the world has changed and is changing. Defence is a theme that seems to have a hell of a lot of legs behind it.
Yeah, I mean, I was looking at its projections for turnover, Chemring this is, and they are targeting a 5-fold increase in revenue to, actually that's more than that, no, it's less than that. So they're targeting an increase of 1 billion in turnover by 2030. So now, for me, I think that presents a big challenge in terms of scaling up its operations to be able to deliver
Well, I think that's now the question for a lot of these defence names. I think it's a case of the demand is there. We know that.
Yeah.
The orders are coming in and they are going to continue to come in. Now, can they actually uphold their end of the bargain and deliver on everything that they're being asked to deliver on and fulfill those orders that are coming in? I think that's now the next question over the next sort of 12 to 18 months. Are these companies able to certainly, firstly, build at speed, but also build at the scale that is needed in order to fulfill potentially insatiable global demand for their products?
Yeah, it sort of pushes back against all of this ESG stuff that was, sort of all the rage as as recently as a year or two ago. Certainly scope for further share price gains there. The shares are around about 14-year highs already. So they're still below the record highs or the highs they were back in 2011. So
Yes.
certainly scope for more gains there. B&M European Value Retail. Oops a daisy, should I say. They fell sharply. I'm trying to put my teeth in. They fell sharply in the aftermath of its full-year results. Profits likely to be lower in the next 12 months due to higher costs in the form of higher national insurance contributions, minimum wage increases, and rising input costs. Why is this a surprise?
Well, I don't think that's a surprise in terms of the fact that their
why
costs
the shares
are going
down
up.
so heavily?
Well, this is the thing. I would argue it's not necessarily a surprise that firms' businesses firms' input costs and wage costs and labour costs are increasing. I think the bigger concern is the fact that it's having such an impact on profitability, clearly a greater impact on profitability than market participants have been expecting. And also, in terms of B&M in particular, their net debt actually rose quite considerably on the year as well, which isn't the most reassuring of signs when costs are rising, your profitability is being eaten into, and the firm is taking on more debt as a result of that to try and keep things in some sort of balance. The reaction is a logical one, if not perhaps maybe slightly overcooked.
So why not just slow down the store opening program? Because obviously that's a sunk cost straight away.
Well, that's probably.
Maybe they need to temper that. There is such a thing as growing too quickly.
Yeah.
Or growing beyond your capability to absorb the rising costs that you're incurring as a result of your expansion plan. I mean, the UK operation is seeing a £75 million increase in its UK fixed rate cost base. That's just UK. Doesn't include its French operation. So, maybe you need to temper that because of the increase in your fixed rate costs.
Yeah, and I think that's the market will probably want to see action on that front. Because it is a case of, okay, things are clearly not as rosy as we'd perhaps thought they were. We also had quite a chunky like-for-like fall in sales. I think it was about 3 or 4%. So total sales grew, but like-for-like sales slipped. So I think there's a few sort of blots on the copybook, shall we say, around the firm. And it's a question of how are they going to address that? And I think, at least to the best of my knowledge, I haven't really seen anything from them as to how they are going to address that. And unless they do provide some clarity on that, then you would argue that the market is probably justified in its reaction.
I would argue an awful lot of that is already in the price, though, when you consider where the share price was, say, for example, 3 years ago. So, but we'll see. That we've dropped quite sharply from 50p to 200p, and while we're still above the lows of this year, we're not that far away from them. So it'll be interesting to see how the markets react in the next 2 to 3 months once all of this is sort of filtered through.
Yeah, I think there's always that knee-jerk move on the report itself, and then there's the dust settling and calmer heads prevailing, etc., etc. So, how it all shakes out will be the key, I think.
Pretty lackluster response to Fever Tree's latest numbers. On track to meet expectations, outperforming in the US market. Molson's deal continuing apace. The shares just close to their highs for this year, actually close to the highs since last September. So pretty much as expected. Not much to get excited about, but also not much to worry. Many investors who got in at the start of this year when the shares were just above 600p, they're now just below 0p. So
yeah, certainly nothing to complain about on that front. Just a case of things are going as well as we expected them to. Let's carry on.
Yeah, absolutely. Dr. Martens shown a clean pair of heels to investors today.
Jeez.
You thought
I was going to have to give you the boot, aren't I?
You thought I was going to do a pun on Fever Tree, and I've disappointed you,
I
didn't I?
I was just thinking I got away with it, to be completely honest, and then bang, there we go.
Yeah. 10% fall in revenue on their full year numbers and a sharp fall in profits, but none of this was unexpected. It was pretty much in line with expectations. I think markets are reacting to the fact that their profit guidance for 2026 has stayed between 54 million and 74 million pounds, which is a sizable improvement on obviously the numbers that we saw today, 34.1 million pound profit before tax. And they didn't see any impact from tariffs as a result of in the context of their outlook, because all of their stock was already in the US.
Yeah, and as a result of that, actually, they are holding off on price increases, which I thought was interesting because obviously, as you say, this is basically the effect of tariff front running in action. They've brought their stock into the country before the tariffs go into effect, which means that it's there, it's sat in a warehouse, and it can be sold for effectively the pre-tariff price, which compared to some other retailers which may not have done that or may not have done that to the same degree, that could perhaps give them some degree of a competitive advantage. And this is why we saw all of that surge in imports in the first quarter, because people are trying to get ahead of that as much as they possibly can.
And it's reflected in the share price today, up 26%, maintain their margins, maintain their profitability. Certainly it looks as if markets are more optimistic, or investors are more optimistic about Dr. Martens than they were back in March when the shares were around about 45p. They are now up at 75p. So fairly decent uplift there.
Yes.
Wizz Air taking a bit of a nosedive on the back of the fact they haven't given any guidance for 2026. Full year profits fell 41.5%. Even as revenues rose, but an awful lot of that is down to the fact that they've grounded 42 aircraft as a result of problems with their Pratt & Whitney engines on its Airbus aircraft, and 34 of those grounded aircraft are still expected to be on the ground at the end of H1.
Yeah, so, they're really struggling with that. And although I think they are getting some compensation from the airline, from the engine maker as a result, it's certainly not going to make up for the hit that this grounding is causing. And to the best of my knowledge, I think Wizz Air have been hit considerably worse than any of the other major European airlines by this issue. So that's an issue in itself. The other problem, of course, being we are going into the busy summer season, and they are going to have a huge chunk of their fleet sat on the ground and not earning revenue flying holiday makers around the continent. So it's understandable why the shares have had a bit of a crash landing today.
I'm going to overlook that.
So have I been grounded now as well?
Yeah. I mean, the shares are basically back to just above 1200p, which was pretty much where the lows were in January of this year and the lows of October 2024. So there's a bit of a flaw there.
Can I just read you a quote? I've got their earnings call transcript in front of me here.
Yeah.
This is from the chief executive, Joseph Verardi. He said, 2027 will be the turning year for Wizz Air. Despite the turbulence, we're still standing. CEOs using puns on earnings calls. That's something I can fully get behind.
He's obviously been listening to our podcast.
As every great market participant should.
Absolutely. Okay, so I mean, but basically what we've seen, I think, so far this week is ultimately, it's the same old story, isn't it? Companies that appear to be doing well get rewarded, and companies that hit a little bit of a roadblock or a speed hump or what have you, or hit a bit of turbulence, they get punished.
Yeah, and I think also we see a continued focus on guidance in addition to the numbers themselves, which again makes a hell of a lot of sense, because given how uncertain and volatile the environment is, it's understandable that investors are also looking at a forward view, not just what's in the rear view mirror. But I guess the biggest earnings test of the week really comes, well, tonight or Thursday night, depending when you listen to that, with this, which is, of course, from Broadcom. Yeah, so it'll be interesting to see how those figures are digested a little bit later on.
Well, that ties into the AI story as well.
Yes,
which
of course.
We'll talk about a little bit when we preview next week in the Apple WWDC, the Worldwide Developers Conference, which is an annual event. Before we move on to that, I want to talk to you about, obviously, disappointing news for the London market this week.
Oh, with Wise, yes.
Wise, yes. Set to move its primary listing to the US, looks to boost its, that comes on the back of, obviously, Cobalt Holdings pulling its IPO, and that had Glencore as one of its key backers, and don't really understand why it decided to take such a late decision to do that.
It was very late, wasn't it?
Well, yeah, I mean, weren't they supposed to IPO today?
I think it was today, yeah.
Yeah. And last night they decided, actually, we're not going to do it now. So, I mean, did that mean that they didn't have, was not the book fully subscribed? And it's come on the back of, obviously, Shine not
they've gone to
doing,
Hong Kong.
or may go to Hong Kong. I mean, I don't know. Is that dead now?
Well, I think it was sources cited by Reuters either last week or the week before were saying that it's as good as dead, and they're going to go and list in Hong Kong instead. Which I would just add that is the third venue that Shein have tried to list in, because they were going to go to New York originally, and then the US politely told them to go away. Then they came to London, and the government trying to bend over backwards to get them to stay here, and they've turned around and gone, actually, instead we want to go away, and they're now going to try Hong Kong. So maybe it'll be third time lucky for them. Yeah, it's depressing, to be completely honest. I mean, you read through the RNS release from I was going to call them TransferWise earlier. That's an old name for them, from Wise, as they are now. They're talking about how moving over to the US brings benefits in terms of strategy, in terms of capital markets, deeper liquidity, greater access to the shares. And you just kind of sat there going, I can't argue with this. You know, they are, sadly, as painful as it is in terms of what they say about the condition of the market in London, they are absolutely spot on in terms of, yes, liquidity is greater. Yes, the market is considerably deeper in the United States. Yes, tech firms are looked upon much more favorably. And I do worry, and I was having this conversation in the office earlier on, maybe it's just because we've had a lot of these stories over the last week, 10 days or so. But are we now at a kind of tipping point where you almost go, this is just going to become a horrible, vicious cycle now, where one firm leaves, which begets another firm leaving, which begets another firm leaving, and everything just dries up completely and entirely? Because setting aside the new listings issue, which is a massive problem in itself, you've also got the matter of, I mean, I've lost count of the number of firms over the last 2 or 3 years that have been trading at ridiculously cheap valuations and been snapped up by either a listed US competitor or by some sort of PE VC fund in the United States. You know, it is a worrying trend, and what's perhaps more worrying is there doesn't seem to be any effort, and I'm not sure what efforts there could be to arrest what we're seeing.
Well, there's definitely a theme. I mean, obviously, Arm Holdings went to the US. Now we've got Wise potentially going to the US. That was another IPO that I remember covering back in my CMC days, as was Fevertree. Was an IPO which I covered in my CMC days, as was Dr. Martens, which was an IPO. And there's a bit of a theme here. I mean, I'm not saying that Fevertree and Dr. Martens could go the same way, but why wouldn't they? They'd probably get a much better valuation in the US. I mean, I'm looking at the valuations of the top 10 listed companies by market cap in the world. It's on a piece done by Jackson Wong on the Good Money Guide website. It's talking about, in the context of a much more buoyant equity market, the fact that we are still close to record highs, and the top 10 companies are Microsoft, 3.4 trillion, Nvidia, 3.3 trillion, Apple, just below 3 trillion, Amazon, 2.17 trillion, Alphabet, 2 trillion, Meta Platforms, 1.6 trillion, Saudi Aramco, 1.6 trillion, Broadcom, reporting tonight, 1.1 trillion, Tesla, 1.1 trillion, and Berkshire Hathaway, 1.1 trillion. You know, so there's only one non-US company in that list.
And I was just actually reading up a little bit more myself while you're going through that list. The other one that we missed as we were talking about firms leaving is, of course, Deliveroo. They've been bought by DoorDash. And you just kind of wonder, it's not a solely UK issue, as that list rightly sort of alludes to. Obviously, we are much more sensitive, much more attuned to it, because we are sat here in the city of London and we're here every day. But what's it going to take? Is it going to need someone like Rolls-Royce, let's say? And this is not a prediction, but Rolls-Royce turning around and saying, we're off to the New York Stock Exchange.
Or Shell.
Or BP, or whoever, a top 10 FTSE constituent, a household name, to turn around and say that before anyone sort of really sits up and actually does anything about it in terms of the powers that be at the London Stock Exchange and on Whitehall in the Treasury, etc. Because At the moment, it just feels like sort of death by a thousand cuts.
Well, yeah, it is, because we can't get the IPOs, and the companies that are, good companies, solid companies, are probably valued at a much lower capitalization than if they were listed in the US. So,
Yeah.
if you're a global company, you really would have to question as to whether or not it's worth your while continuing to be listed in London.
Yeah, and I think it's as we just discussed with Wise, it's very easy and straightforward to come to the conclusion of actually, no, it's not worth your while.
Anyway, on that optimistic note.
I was going to say we've really cheered ourselves up with that, haven't we?
Well, no, I mean the thing is, Michael. I mean, what gets me is that we know what the problems are. They've been talked about. I mean, I've read numerous missives on this topic from people like Simon French at Panmure about it and what can be done to improve the UK's attractiveness as an investment destination. And ultimately, all we hear in Whitehall and government is the sound of silence.
Yeah. Absolutely. I mean, yeah, we've gone through it ourselves in terms of what can be done. I mean, for just the easiest lever to pull would just be get rid of stamp duty on equity transactions.
That would be a big win. That would be an easy win. That
would improve liquidity massively.
Yeah,
and
that'd be an easy win.
It cannot be that difficult for the Treasury to do that. Yeah,
but it's not just that; it's capital gains tax as well. I mean,
no, absolutely, there are other factors at play.
And then you've got idiots like the Deputy Prime Minister talking about inheritance tax on AIM and stuff like that. I mean, why on earth would you invest in anything remotely risky if you know that your capital gain at the end of it, you're going to get clobbered clobbered for it?
You're just not going to do it. You're absolutely not going to do it. There's no incentive at all.
And the likelihood is that next week's spending review, which brings me
I was going to say a very neat little segue there.
Yeah, is going to compound the challenges facing the current government, because we've already seen that they've U-turned on the winter fuel allowance. To what degree we don't know yet, but more pensioners will find that they qualify for it. Potentially lift the 2-child benefit cap, and pledge to deliver defence spending up to 2.5% as a bare minimum. We're talking here. The US has just called for it to go up to 3 to 5%.
Yeah.
How are they going to fund all that?
Well,
this is a 3-year plan. They might as well sketch it out on the back of a fag packet.
Well, I might be being slightly uncharitable here, but I think they probably have, given some of the recent announcements and lack of strategy that we've had from the government. I mean, it's going to attract a hell of a lot of headlines, but I don't think we're going to learn anything new from the spending review that we didn't already know, to be completely honest, and it certainly isn't going to alter the trajectory, which is that we're rapidly careening towards the budget in autumn, and we're going to end up with a whole load of tax rises yet again, because what we've got fundamentally is government by spreadsheet, where they are so bound by their fiscal rules, which are inevitably going to be broken within about a year of meeting them the budget, because they're operating with such wafer thin margins, and the Chancellor simply does not have the necessary credibility with financial markets to change those rules. So we are just sort of stuck in this loop of higher taxes and lower spending, and it doesn't seem like we're going to get out of it anytime soon. And of course, this is at a time where we're saying lower spending, but actually spending demands are increasing, as you said, in terms of defence and also in terms of healthcare. So it's those non-protected departments, things like culture, media, sport, education, transport, all that kind of stuff, they're the ones that are going to be clobbered the most.
Indeed. So yeah, it'll be very interesting to see how the bond markets will react to Rachel Reeves' speech. Did you actually see the speech up in Rochdale earlier this week, where all these people were basically lined up behind her?
Yes.
And they all looked as if they'd rather be somewhere else.
Yeah, I
really felt for them. I suddenly thought to myself, that'd be me. I'm thinking, oh, when does this finish? Because I'm done.
Well, I was going to say they probably speak for the majority of the country actually having to listen to her. But yeah, I imagine there were a few meetings with HR the next morning in that firm after that was all over the 10 o'clock news.
That's a great exercise in monitoring body language, isn't it?
Oh, absolutely. And a great exercise in how not to stage manage an event as well.
Oh, that's glorious. I just couldn't resist a chuckle at that. Anyway, so we've got April GDP. We got off to a really good start. January, February, March, really strong quarter. Best quarter in a year, in 12 months since the first quarter of last year, 2024. Not really going to. I'm struggling to really, I think, come to any sort of degree of idea as to what the number will be.
Yes, I think most people probably are, to be completely honest with you. I mean, if you think about firstly, just to sort of frame the data, as you said, we have had a surprisingly solid recent run in terms of monthly GDP prints. 4 out of the last 5 decently positive.
We have got Easter, so hopefully services should actually contribute a fairly
Yeah,
decent performance, but we'll see.
exactly. The only thing that I would say is if we did see a boost from potential tariff front running in the Q1 numbers, do we see that given back in the April data? But I've always been, since the series was first brought about by the ONS, which is probably getting on for 6 or 7 years ago now, always been a little bit skeptical of monthly GDP. It's a very volatile number. And certainly when you've got the ONS coming out on an almost daily basis with a correction or an apology or a revision to some statistic or another, doesn't exactly fill me with confidence to sit here and go, well, next Thursday we'll get the April GDP number and that will be the definitive read on how the economy is performing. I think we do need to take it with a pinch of salt, shall we say.
Well, they got CPR wrong, didn't they?
Yeah, exactly. I mean, come on.
Anyway,
It's
so
it
we've
is
got
getting
wages,
to
we've
the
got
point of
unemployment,
farce
and
at
we've
this
got
stage.
I mean, we've got April unemployment, April wages, and April GDP. So maybe we'll get further evidence of a bit of a slowdown in hiring in April, given the tax changes or the national insurance changes.
Yeah,
This is the 3
potentially.
months to April.
It is, yeah, and I think this is where we're going to see the first potential effects of those national insurance changes begin to potentially show up. It is very, very early, and as you say, it's a rolling 3-month period. But yeah, it's certainly worth watching. But again, having just complained about the ONS, that applies in terms of the labour market data as well. They can't bloody well get that right either. What will be interesting is the earnings numbers. If we see earnings still running at almost 3 times the BOE's target, that is going to be of some concern to the hawks on the MPC, although you would expect the April number probably going to be skewed higher anyway, given minimum wage, index-linked pay rises, etc., etc.
And yet we've got a public sector pay round coming in June and July as well. So that'll be interesting.
Already you hear reports that, positioning, as you say, the pay rises that are being offered aren't good enough.
No. Well, we've got US CPI. Again, that's not really going to add to the sum of overall knowledge when it comes to when the Fed's going to cut rates next. Obviously, weekly jobless claims, we saw a little bit of an uptick today, but your favourite, which was continuing claims, softened a little bit.
Yeah, and I think that was a little bit of a mixed bag. Obviously, this comes ahead of the May non-farm payrolls number that we get tomorrow. So if you watch this after 1:30 on Friday, then this analysis could be out of date. But yeah, I think fundamentally the Fed are in wait and see mode at the moment. And I think we're still in this mindset, particularly when it comes to inflation. Obviously, the April CPI report was relatively soft. We're still in this mindset of if we get another soft report, it's a case of, well, we know the tariff-induced price rises are coming at some point. It's just when are they going to arrive? And they just haven't arrived yet.
Prices paid for the ISM manufacturing was still pretty lumpy, wasn't it?
It was, yeah, and for the services number as well.
And I think that's why Powell is so reluctant to even countenance a rate cut.
Yeah, and of course the other issue that Powell has got, and I wrote about this in a note this morning, him and Trump actually met, I think it was on Monday or maybe towards the back end of last week, and Trump was pressuring him in person to lower rates. We then had, after the ADP employment figure, which was soft yesterday, Trump on Truth Social banging on about how Powell is being too late and he needs to lower rates. The issue is, obviously the Fed are going to set rates objectively, but the more Trump shouts about lowering rates, the harder it is optically for them to actually deliver a rate cut because it looks like their independence is being called into question. Now, clearly, the Fed are going to want to try and stay above the political fray as much as they can. But I think it just, with almost every tweet from Trump saying Powell is being too late, it just nudges the bar to a cut even higher because they will want to effectively prove beyond doubt that they are setting policy independently.
Yeah, I think Treasury Secretary Mr. Bessent needs to have a word in Trump's ear
Again,
again.
because we had this, probably a
It's
month
about
or so ago.
optics. It's about
That's
optics.
exactly what it is. And, as you say, we had this a short while ago when we had all of those stories coming out about, is he going to sack him? And the Wall Street Journal reported that, Bessent's talked him down off the cliff and even Lutnick was involved, etc., etc., etc. It is getting to a case again where I think they need to go and give him a bit of a tap on the shoulder and say, come on, Mr. Trump, let's rein it in a little bit on that front. I wonder, and I did say this in a slightly tongue-in-cheek manner, but I'm starting to think there's a bit more seriousness behind it now. 4,800 on S&P, you can call that the Trump put, for want of a better word. 4,900. That's where he pivoted on the Liberation Day tariffs. Are we now dealing with a Trump call at about 6,000? Where the market is, all is well and good again, complacency starts to set in, and, we go down the route of being a bit more outlandish in our public statements before the market comes off the boil and Scott Bessent has to rein him in. Is that now the environment that we trade in?
Yeah, I mean, the 6,000 has capped it pretty much for most of the past month.
Yeah.
Every time it's tried to push through it, it's come straight back off again.
Absolutely.
So it'll be interesting to see what happens when it does finally get a foothold above there. Anyway, We'll finish off because we've only got two more items to look at. First quarter numbers out of Tesco's. I think they're going to be a decent bellwether of where the UK consumer is. I think better than any ONS data can tell us.
You'll know this better than I will, but they're still the largest supermarket by market share by quite a long way, aren't they?
Oh, huge. Absolutely huge. And I think in the wake of their full year numbers, we saw a little bit of a sell-off because they revised their guidance down for 2026 in terms of their group adjusted operating profit for the upcoming fiscal year to between 2.7 and 3 billion pounds. The actual underlying numbers themselves over the last 12 months were really positive. But it turned out to be a classic bear trap.
Yes.
Because since then, the shares have gone straight back up again. And I think one of the things that I took away from a recent announcement that Tesco management made was about they're looking to restrict their opening hours. Now, that suggests to me that they're looking at different ways of lowering their cost base.
Yes.
And also, now what do they say? Yeah, they're already feeling the effects of the increased national insurance and minimum wage costs, which they said it would cost them £250 million. So to offset some of this, they're going to restrict the opening hours in some of their stores. Not sure how their staff are going to feel about that, because obviously it's going to mean, less money.
Yeah.
But more than that, I think the area that's worth keeping an eye out for is the booker business. Now, why do I say that? Well, I think it's quite simple. The last 12 months, they were the biggest drag on the overall business due to underperformance with like-for-like sales. And that was largely due to weakness in its tobacco business as well as the fast food market, which is serviced by Best Food Logistics. Now, they supply Burger King, Pret a Manger, Pizza Express, Zizzi, Nando's and Pizza Hut. Will we get a bit of a pickup in business there, or will that part of the business continue to contribute to weakness on the bottom line and the top line?
Yeah, I think that's the way to frame the Tesco earnings to me, as a bellwether, as a barometer of how things are performing more broadly. And Booker, of course, really useful for that because they are the wholesale arm. They are supplying other businesses within the economy. So they are a leading indicator. If their sales are struggling, then it means that likely the orders aren't coming in the same magnitude from other parts of the economy. So other parts of the economy are likely struggling. And I also think it's interesting in terms of the opening hours aspect. And then you sort of end up questioning, is that a strategy that other retailers end up starting to use in order to try and keep their costs to a minimum? Or do we see, if it's not opening hours, is it rotated hours? We have fewer members of staff in shops, greater proliferation of self-checkouts, all that kind of thing. So I think they're the two sort of trends to watch. But as you said, the way the share price has traded over the last few months is very, very interesting indeed.
Yeah, it certainly seems to me that investors think that Tesco's got a handle on its cost base, and that announcement, I can't remember when it was. I think it was last week or the week before. Was certainly, I think, emblematic
recently,
of certainly a change in the way supermarkets are looking at trying to hone their business model. What's the point in keeping a shop open if there's no one in it?
Well, exactly. And I think I'm going to sound like a bit of an old man now, which some people say nothing new there. We've almost moved on from these days of 24/7 supermarkets. So that's great. But nowadays I can sit there on my phone at 10 o'clock at night and Amazon will deliver what I want to my door by the time I wake up the next morning. So why do I need a 24-hour supermarket? That's one of the arguments.
It's funny you should say that, because I ordered something on Amazon Prime yesterday morning and it arrived at 9 o'clock the same day.
It blows my mind when that happens. Well, now, and people are probably sat there listening to this going, oh, well, that's normal. That's how the world is now. What are these two on about? I just find it staggering that I can click a button like you did, and then, a man arrives half a day later, and there's what I was after. It is brilliant.
Yeah, it's very, very convenient. Anyway, let's finish up with Apple. Worldwide Developers Conference. It's always a keynote event for Apple watchers. Does it really deliver in terms of new hardware? No. But I think what it does do is it speaks to a direction of travel. And I think one area that Apple has really lagged behind all of its peers is artificial intelligence. They just can't do it. Siri doesn't appear to get anywhere close to the likes of Microsoft or Google or Alphabet. I can always call them Google. And AI and virtual reality headsets. And I think perhaps this could be a good opportunity for them to try and showcase what they're looking to do to play catch up in this particular area. Because to all intents and purposes, and this is just my experience, they haven't really delivered anything particularly new and exciting since the iPhone.
No. Absolutely not. I don't think they have. Sorry, I was slightly distracted there by Trump waffling away about what he spoke about with President Xi, which seems like not a lot at my first read of that Truth Social post. But no, I think you're absolutely right. And I think, I'm certainly not as au fait with technology as you are, but the degree of innovation coming out of Apple seems to have ground to a complete halt in recent years. As you rightly say, the iPhone was the last sort of truly revolutionary thing that they did. The goggles, the Vision headset thingamajig that they built, that seems to have flopped terribly. The AI that they're building is way behind, as we were talking about in the pre-show, way behind any of their competition. You can name 10 companies that are performing better on that front. They just seem to spend a lot of their time playing catch-up at the moment. All the while, of course, dealing with this thorny issue that the bulk of their products are made in China. And if they're not made in China, they're made in India. And that's looked upon about as dimly at the moment. So, I think it could be an interesting event. But when the biggest pre-WWDC leak is that they're going to now name their operating systems after the year rather than just counting sequentially, I won't be getting my hopes up. Let me put it that way.
No, indeed. I think the bar is low. I mean, I think there is an opening in gaming, virtual reality gaming. There's still very, very few games that you can actually buy a virtual reality headset for. I think most of the industry is behind on that. And so it'll be interesting to see whether or not the Apple Vision Pro, they add gaming features to it, because I think that could be the next step when it comes to artificial intelligence, but also virtual reality.
Yeah.
Anyway.
Yeah, and it's going to be interesting whether there is anything concrete on that one. But as you say, the bar is an incredibly low one going into the conference.
Okay, so that's it for this week, unless you've got anything you want to add, Michael. Otherwise, we will wrap this up.
No, I don't believe so. I mean, the only thing I would say is there's just a few big risks over the next 24 hours or so in terms of, as we mentioned, the Broadcom numbers, how all of this stuff between Trump and Xi shakes out, and then the May jobs report Friday lunchtime. So just be alert to those events in addition to the ones that we've already covered.
And obviously we can talk about all of that stuff when we sit down next week.
Next week, exactly that.
Alrighty. Okay, well, thanks once again, everyone, for tuning in. Until same time, same place next week. In the meantime, have a great weekend, and we'll speak to you all next week.
Bye for now.